Welcome to Quantitative Financial Data Analysis in MATLAB 2020. Since we have now acquired the corresponding econometric skills, what you would like to do now is that we go through different exercises and we will make use of everything that we derived on the whiteboard. And now we will go through the first part of the exercises. We start with the first task that we have here defined, and this is to create the excess return matrix of the S&P 500 survivor stocks. So I will give you on Moodle different matrices, and the matrices that I will give you are the risk factor matrix. You will get a matrix of S&P 500 survivor stocks, and you will get a Excel file corresponding of the US risk-free rate. If you just double click here, open the matrix, the Excel file that contains the matrix of US risk factors. So as you see here, when we open that Excel file, in the first column A, we have the corresponding months. The dataset starts obviously in January 1973, and it ends in May 2014. So we have obviously 497 time series observations of our risk factors. The following risk factors you will get, it's in the first column we have the market factor in excess form, which is the CRISP index for the US. In the second risk factor is the size factor for the US. The third risk factor is the value factor. The fourth risk factor is the profitability factor, robust minus weak. We have the fifth risk factor, which is the investment factor, and defined as in Palmer and French 2015 paper. And finally, we have here as last and sixth risk factor, the momentum factor. As we have investigated in the 2018 paper from Palmer and French, denoted, which is entitled Choosing Factors. And we have discussed this paper in the RFM course this year. So this is obviously a T by 6 matrix, where T is 497 and K is 6, if K denotes the risk factors. So if we open here the Excel file for the US risk-free rate, let's do that. This is also the Excel file that you have on your Moodle page. Again, it starts, of course, at the same point in time in January 73, and it ends in, of course, here in May 2014. And as you see already here, we have here 0 entries basically. So the risk-free rate in the US, like in Europe, is basically 0 towards the end of the sample. So it continuously decreases as time goes by. So that's a T by 1 vector, obviously. Since we have 497 time series observations, this is a 497 by 1 vector. Then you have this matrix here of survivor stocks. Also in Moodle, let's open this Excel file as well. Here it starts in the first column here. We have again the time dimension or the time series, the months, the corresponding months. And here from column B onwards, we have here obviously 184 stocks from the S&P 500. So, and these stocks have been, if you go here on the next page here, so again, the sample is from January 73 until May 2014. We have the index composition as of October 1989. And the sample consists of those stocks that have been in the index as of October 89 yeah, and are still in the sample in the end of the sample, which is May 2014. So these stocks obviously survived roughly 25 years in the S&P 500. Yeah, think about it. We have 500 stocks, and out of these 500 stocks that have been in the index as of October 89, only 184 are still in the index in May 2014. Yeah, so this matrix here, obviously, is then a T by N matrix. Yeah, if N denotes the number of stocks and T denotes the time dimension, it's a 497 by 184 matrix. So then obviously I expect that you are able to retrieve MATLAB, any MATLAB version. Yeah, I think my version is from 2013 or something. It doesn't really matter because all of the versions are very similar. And so I expect that you somehow get this program. Yeah. For instance, I asked you to acquire the student version. I'm not 100% sure what's the price for it. I expect it's something like $50 or $60. And as an alternative, you have access to the trial version. And as far as I remember, you have 14 days basically access to the full version, yeah, of MATLAB, yeah, if you download the MATLAB trial version. So there are different ways to acquire MATLAB. I think it's a very nice program and it's a very good investment. Yeah. So if students go to a bar, yeah, so they easily drink for 50, 60 euros or dollars at a weekend. Yeah. So that's the opportunity cost for this program. Yeah, if you acquire the student version. And the student version is for my course enough because we will not use any fancy packages. We will code everything by ourselves because I want you to know how the program is working. Yeah, and I want you to know what you are doing. And this was the purpose of this course. Yeah, basically, the only thing that you need to know is basic econometrics. Once you know basic econometrics and the corresponding, which obviously requires a whole bunch of matrix calculus. Once you know that, you know what you do, and you know also where things can go wrong. Yeah, if some assumptions are violated. So that's basically what I want you to do. I want you to know what you are doing. You should be able to implement simple econometric formulas into a matrix-based program such as MATLAB and be able to investigate large data sets. So let's open MATLAB here. I have it already on my computer. Yeah, if I just plug it in here, MATLAB, obviously, then it gives me this icon here. I just push the button and it opens the corresponding program here. And I have obviously the 2014 version, yeah, 65-bit. Yeah, but it doesn't really matter because all of these versions are pretty much the same. It takes some time to open the program, obviously. Yeah, once you open the program, this is what happens. This is what you see. Yeah, here's the command window. Command window. Here you can basically write in the formulas and so on and so forth. But we will come back to that very soon. So let's first take a look on the exercises. Yeah, again, the first exercise that I would like to go through with you here is to create the excess return matrix of the S&P 500 survivor stocks. That's the first task. The second task is, okay, estimate the Farmer and French three-factor model parameters for all stocks. And we know the Farmer and French three-factor model has obviously three risk factors. The first risk factor is the market excess return, yeah, for the US. The second risk factor is the size factor, which is a portfolio that is long on small stocks and short on big stocks. And the third risk factor is the value factor, which is a portfolio that is long on stocks that have a high book to market ratio, so-called value stocks, and is financing this position by shorting growth stocks, that is stocks that have a low book to market ratio. Yeah, if we translate it into our formula here, obviously, yeah, we have here on the left-hand side, YIT is the gross return of stock I at time t. RFT is the risk-free rate at time t. So what we have on the left-hand side here is the excess return of the corresponding stock I. On the right-hand side of this equation, we have here an intercept term, alpha I, which denotes the intercept term, the unexplained return of this stock I. So it's the part of the excess return of stock I that is unexplained by the exposure against the three-factor model. X1t denotes the market factor in excess form at time t, x2t denotes the size factor at time t, x3t denotes the value factor at time t, and here UIT is obviously the error term of stock I at time t. And our standard assumption in our OLS framework is, as we already derived or discussed on the whiteboard, that the error term is distributed as normal with expectation of 0, the mean of 0, and standard and a volatility or a variance of sigma square I. Then our task is, okay, we should store the estimated model parameters in a matrix. Then we also want to have a look on what is the range of the factor loadings. And one way to do it is to plot the distribution of the factor loadings across our assets. And again, we have 184 assets, which are the 184 survival stocks of the S&P 500. Here a note, so that's our well-known and derived OLS formula that we derived, or that we made use of and derived on the whiteboard many times in our course. Then the third exercise is a subsample test. The question is, do small survival stocks perform better? So what do? We divide the overall sample into two subsamples. We estimate the size factor loading exposures across all stocks for the first subsample. Then we create two portfolios that consist of 20% of the smallest stocks and 20% of the largest stocks with respect to the first subsample. So we condition everything, we condition our model on and estimate the parameters given the first subsample. So then we construct a zero-cost strategy that is long on those survival stocks that had the highest exposure against the size factor in the first subsample, and short on survival stocks that had the lowest exposures against the size factor in the first subsample. And we estimate, we keep this portfolio constant, and we estimate, okay, what's the performance in the second subsample? That's an out-of-sample test. So the question is then, okay, what's the return spread of the zero-cost portfolio in the second subsample? So the portfolio again consists, we are shorting those stocks that had that are small, that have been small in the first subsample, and no, we are buying stocks. Once again, we are buying stocks that are small in the first subsample, and we have a look on, okay, what's the performance in the second subsample, and we are shorting stocks that are big in the first subsample, and again we check what's the performance in the second subsample. So according to Farman French, the spread between small stocks and big stocks should be positive and significant, which is the so-called size anomaly. Then our fourth exercise here, it's denoted as the topic is time-varying betas. So use the first stock in the excess return matrix and estimate the loading against the excess market factor, the size factor, and the value factor across time. Use iteratively a rolling time window of 60 months. Store the time-varying estimates for the exposures in the matrix and plot each of them across time. So let us start with the first exercise, okay? Very simple. We create the excess return matrix of the S&P 500 survivor stocks. So how do we proceed? So we have opened our MATLAB here already. That's our window. And first we have to import the data matrix. So First, we have to find it. Where is it located? It's obviously in MATLAB Lectures 2020 folder for me. Double click on the matrix S&P 500 survivor stocks. It's a large spreadsheet. That's a lot of data, big data. It takes a little bit time for MATLAB to open that. Then this wizard here opens, obviously. So here we have basically all the vectors of stocks, of the gross return vectors. Yeah. We don't need the column A because here we have just the corresponding months. Yeah. So we leave it as it is. And we can here basically a little bit adjust it. So we can basically, if we do it like this, if we move this to the right-hand side, we skip these first stocks from column B to column E. Yeah. But we don't want to do that. We want to have all stocks on all sample. And so we push here the matrix icon, because if we would not do that, it would import everything as column vectors, yeah, and not as a matrix, but we want to have it in the matrix. Then we push this green button here, this OK button, and now it is imported in the system. Yeah, and this is how it's denoted. And again, it's a 497 by 184 matrix. If you click the wizard away, here is now the matrix that we have. If we now double click, it gives us again here the matrix in the upper part of our window. And here, it's on the right-hand side value, it gives you the dimension of this matrix. Yeah? And let us just rename this matrix. Let us call it Y. Yeah? Because as in my course, Y always denotes the matrix of stock returns. Then next, we import the vector of risk-free rates. Again, we find it in MATLAB Lecture 2020. On my computer, yeah, it's the Excel file is denoted as US_risk-free_rate. We double click with the mouse, and once, yeah, it opens now. Again, we just need to push the OK button because this is just one vector. Yeah, we can also push matrix here. I think it doesn't really matter. Matrix and vector is anyways the same. It's just the dimension that differs from vector and matrix. So of course, push the OK button, and here it's a 497 by 1 vector, yeah, and it's denoted in our operating window as US risk-free rate. Push the wizard away. Let's rename it. Yeah, push the right on your mouse, the right click, and then this pops up. We rename it as RF. Okay, very simple. Then we import now the factor matrix. So it's here, risk factors, denoted as risk factors. Double click again on the left button from your mouse. And then again, we want to actually for this first exercise, we only need the first three vectors here, the market factor in excess form, the size factor, and the value factor. So we move this here, yeah, with our mouse. Yeah, we push on the left-hand button, yeah, and just press it, and then we can move it here, yeah, like this. So now we have basically we denoted now, we marked now these corresponding vectors that we want to import. Yeah. Then now we have defined which matrix we want to import. Then we push again here on the matrix button, and then here on the OK button, and now it's uploaded as matrix denoted as risk factors, and it's a 497 by 3 matrix. Then we push the button, we push again the wizard away, and let's denote our risk factor matrix as F, capital F for factor matrix. So now we have defined our matrices, and now again, what do we want to do? We want to create the excess return matrix of the S&P 500 survivor stocks. So instead of writing here on the in the command window, if you just write F now, which is our factor matrix, and we push the enter button, MATLAB spits us immediately out what it is. And obviously, it's this long T by 3 matrix. Yeah, and the same for RF. MATLAB spits out what it is. The thing is, if you write a code, if you write something here, if you write an equation or a code here, and something goes wrong, then you need to write everything over again. So it's much easier to use this function here, new script. Yeah? Push this button here, new script, and this wizard here, or this sheet pops up. And here we can now write without running the code. Okay, so let's start with the first exercises, which was to create the access return matrix. Access return matrix. And whenever you use this percent sign, then MATLAB recognizes that it's just a node. Right? This is not a part of the code. It's just a node. If you do not do that, MATLAB would recognize it as a command. So, and obviously everything is green as well. So everything that is not a part of the code is always in green, and you have to mark it with the percentage sign. So first, let us define what is the time dimension. So it's capital T. It's the length of our Y matrix. Yeah? We can now copy this and run it in. And again, if we have this colon, if we do not have this colon, yeah, then MATLAB would immediately spit out what it is. Yeah. So let's do that. Yeah. So you see, so MATLAB would spits us out that T is 497, because this is the length of our return matrix. Yeah. So if we do not want that MATLAB spits us out what it is immediately, we have to push this colon here. Now let's copy that into the command window. Yeah. We mark it, and then we push on CTRL and C, then it's copied, and we paste it here in this command window, and you see it doesn't spit us out immediately what it is. So we know that our factor matrix and our risk-free rate has the same length. All of these have the same length. So it doesn't matter if I define T as length of Y or length of F or length of RF. It would always define T as 497. So it doesn't really matter. So next we have to define, okay, what are the stocks? N is our stock dimension, and we know 184. And you can also read it actually here from the window. Here we know that the column dimension of Y is 184. So next we define a new matrix, and this is now our access return matrix. We define it as capital Y1, and we create now a zero matrix where we store our access return matrix in. So we define it as zeros. It has obviously the same dimension as our Y matrix, which is T by N. We have 497 rows, time series observations, and 184 columns, which denotes the dimension of our stocks. Then we have a for loop. It's the first time that we operate with a for loop. For j is 1 until n. Yeah? So now we want to do something in the column dimension, obviously. We start with the first column when j is 1, then we go to the second column, j is 2, then to the third column, j is 3, until the last column, j is n. So we do something here 184 times. So what do we do? So all rows, the first item here in the parentheses, this is the row dimension. The second is the column dimension. So, and this double point means all rows. All rows. So if j is 1, it says, okay, put something in the first column here, j is then 1, in all rows. And what do we want to store there? Well, take the same entries from our Y matrix. So you see, it's exactly the same. Yeah, it's the same dimension. So we put in the same vector, the same time series vector, and we subtract the risk-free rate. We know that RF has a dimension 497 by 1, and the first column vector in Y has the same dimension. So 497 by 1 vector minus a 497 by 1 vector is again a 497 by 1 vector. Yeah, and we do this for each column in our Y matrix. Yeah. So we end this for loop. Always we have to end the for loop. And now what we can do now is we copy this code into our command window, paste, and voila. What we see here now in our workspace window, our new matrix Y1. Yeah. So Y1 has the same dimension like our Y matrix, of course, but we have subtracted from each column vector the risk-free rate. So we see here already Y1, the first entry here, the excess return of the first stock at time t is 1, which is obviously January 73, is 2.5572% in that month. The gross return, the corresponding gross return is 2.9972. Yeah, so very simple operation. Of course, there are also other ways to do that. Yeah, you will recognize in MATLAB everything is possible. So you can always have different ways how to implement something. We could also obviously do it with 2 for loops. Yeah, so instead of having this one for loop, we can say, okay, y1 ij, sorry, let us do it here. Oh, no, we have to, let's write it just out. So we can say, okay, for I is 1, for I is 1 to d, for j is 1 to n, y1 ij should be y ij minus rf I. Because we have 2 for loops, we have to end both for loops. Yeah. So if I now copy this and run it in MATLAB, everything that I've done here is overwritten. Okay, so that's usually the case if you that you overwrite something. Yeah, if you do not store it. So let's copy this in our command window. Voila! Now we have overwritten. We have now a new yi, and obviously it's the same. You remember previously it was the first entry was 2.5572. Now it's the same, 2.5572, and the same is true for all the others. Yeah. So there are always different ways how to do something, and obviously it's a little bit easier if we have only one for loop. Whenever you can save a for loop, do it. Obviously, because then the code runs faster. But anyways, we have so much computer power that it doesn't really matter. So this was the first exercise. We have created now the excess return matrix of the S&P 500 survival stocks. Now, the second task was obviously we estimate the Farman French 3-factor model parameters for all of these stocks. Yeah. And we want to have a look on, we want to store the results in a matrix. Yeah. And we want to have it when we want to check what's the range of the factor loadings across our stocks. And the note here, this is of course our well-known formula that we will now apply for the first time. So that's our second exercise. In French model. So, and obviously, because we have 184 stocks, this would be very time consuming to do it in a program such as eViews, because you would do it for each single stock. It would take ages. So here, obviously, it makes sense if you have a lot of data to use a matrix program. So let's do it. We first of all, we want to store our results. Let's store the results in a matrix P. P has then zeros and has we have n stocks, and we have 4 point estimates. And we have the alpha, want to store the alpha, and as you see here, we have to store the 3 exposures against the risk factors. So we want to store it in a matrix P, that has obviously as much rows as we have stocks in our sample, and the column dimension in each column denotes the corresponding factor exposure. So what we do then is we have a for loop. We have to operate with a for loop. No, first we want to define what is our X matrix. So our X matrix obviously is defined as we have to create a new matrix here. First we have a vector of ones, and it has t observations because we have t times these observations. So this gives us now a vector of ones, that has t observations, and it's a column vector. So we have one column and t rows, so that's a column vector. So that's the first vector in our X matrix, and then we add just our factor matrix. So if we would copy this into MATLAB in order to see what it is, we just mark it here, okay? Push CTRL and copy and see which copies this command, put it in here and push the enter button. So what we have is obviously a T by 4 matrix, with 497 time series observations and 4 columns. Well, that's our X matrix. So in our Y1 matrix, we know that in our capital Y1 matrix, here we have the excess returns of our corresponding stocks. So now we operate with a for loop. For do something for J is 1 until capital N. So we do something for our N stocks. So what do? We say E, which gives us the point estimates for our OLS parameters, is equal with X transposed times X, parenthesis closing, inverted, and put the parentheses here, but I think we don't have to do it, but I do it, times X transposed times, go to our Y1 matrix and take the first column and all rows. So this basically gives us, if you go back to this formula here, it is this formula here, the simple OLS formula, and now our Y is the vector of excess returns for our first stock. So, and obviously this is a for loop. It starts with J is 1. So in the first run, this is 1. In the second run, this is 2. In the last run, this is capital N. So, and we could always, for each run, we get a new parameter vector here, which is a 4 by 1 vector. Because we have obviously 1, 2, 3, 4 parameters to estimate. So what do we do with these guys? So we store it in our P, in our result matrix. So we store it in P K double point is equal with B transposed. So B, if we run this formula here, it gives us a 4x1 vector. But we want to store these results in the first row of P. The first row, yeah, in the first run when J is 1, yeah, that's a B, that is a 4x1 vector. And what we have here, if this is 1, and we know that P has the dimension, has a column rank of 4, this is 1 by 4. Yeah? In the first run, this is 1 by 4. So what we have to do is, we have to transpose our point estimator at beta. Yeah? So that it has the same dimension. 4 by 1 transpose is 1 by 4. Yeah? So now we end this, and that's it. Yeah? If we now copy this, let's hope that it works. Yeah? I haven't tried this code here, but it should work. And yeah, it works. So let's now see our P. In our P matrix, we have now in the first column, of P, we have obviously the exposures against the market. This is the alpha across our 184 stocks. Yeah, you see here P has the dimension 184 by 4. So in the first column, we have the alphas of our 184 stocks. So in the first row, we have the first entry here is the alpha of the first stock. The second entry is the alpha of the second stock. The third entry, the alpha of the third stock, and so on. In the second column, the first entry is the corresponding market exposure against of the first stock. The second entry in the second column is obviously the corresponding exposure against the market factor of the second stock, and so on and so forth. So now let's plot, let's see the evolution of the alpha across our universe of survivor stocks. So how do we do? Let's just plot E, and we want to stock all entries in the first column to close both parentheses. Okay, so that's the command, plot, and then what do we plot is in parentheses here, and the parentheses is what? Okay, our result matrix P, and we want to plot in the first column all rows. Yeah, what we will see is now the evolution of the alphas across stocks, and this is what it gives us. Yeah. So obviously it ranges between -1 per month until 1 point something. Yeah, if we push this data cursor button, we can see here that this guy here, our stock number 87, has obviously a corresponding alpha of 1.157. Yeah. And this guy here, obviously, our stock number 171, survivor stock 171 in our sample, had an alpha across the sample of -1.081. And this is in percent per month, obviously. So we also can insert here something. We can insert an X label. Yeah, we can write alphas of the survivor stocks across time. On the x-axis, we have the survivor stocks, right? So we have to write here survivor stocks, and then we can have an X label as well, insert a Y label here, and then we can write that's the alpha. Okay, that's as simple as that. So let's push this away. Let's also check the evolution of the market sensitivity across our stocks, now we just can write here 2. We want to plot the second column, all entries, which gives us the corresponding exposure against the market factor of across our sample of survivor stocks. And you see here, obviously, it ranges from 2 point something. Let's see, it's 2.09, which is a very high beta, market beta. And here the lowest market beta is obviously here, this guy here, and that's 0.3395. Yeah. And it's the cyber stock 156 in our sample that has this low market beta. Yeah. So the beta, we can also sort it. Yeah. Sort this guy, instead of plot, we just write sort. Now we get the sorted market exposure in an increasing order. And obviously we see here, the highest beta is 2.09 in our sample, and the lowest beta is 0.3395. Yeah. So it's linearly increasing here, obviously. So that's what we can do. We can also plot the exposure against the size factor, which is obviously then the third entry here. So size, obviously, we have here high loadings of size of 1, or actually it's above 1 even here. So it's 1.09, 1.094 of the stock number 142, and the lowest is here minus 0.82. So obviously we have small stocks and big stocks in our sample. So obviously when the exposure against the size factor is large, this means it's a small stock, like this or this, because it co-moves with the long leg of the size factor. Whereas this stock here obviously is a big stock because it's negatively correlated with the size factor. So it's exposed to the short leg, which is big stocks. So stock number 108 obviously has a negative exposure against the size factor of minus 0.8575, and that's obviously then indication that this is a big stock. So we can put it away again, and finally we can also plot, check the value factor, and is a similar picture that we see here, obviously. So we have stocks that co-move positively with the value factor. Here we have the highest values from survivor stock 113, which has a loading against the value factor of 1.33. This is obviously a value stock. It co-moves with the long leg. And we have here, this stock here is stock number 87 in our sample. It has an exposure against the value factor of minus 0.6359. So that's obviously, this stock is correlated with the short leg of the value factor, which is growth stock. So this guy here is obviously in a growth stock. So that was the exercise number 2. Let's go to the third exercise. So what we have to do is a subsample test. So the question is, do small survivor stocks perform better? Divide the overall sample into 2 subsamples, estimate the size factor loading exposures across all stocks for the first subsample, create 2 portfolios that consist of 20% of the smallest stocks and 20% of the largest stocks with respect to the first subsample. Construct a zero-cost strategy that is long on survivor stocks that had the highest exposures against the size factor in the first subsample, and short on survivor stocks that had the lowest exposures against the size factor in the first subsample. What is the return spread of the zero-cost portfolio in the second subsample? So that's what we do now. So the third exercise is obviously a subsample analysis slash, or actually out of sample analysis. So how do we proceed? So first of all, we have to access the first subsample. Let's say we have 497 time series observations. Let's say we use the first 250 observations for getting our point estimates, for determining the loadings against the size factor. So T1, capital T1, 250 are the first 150 observations that we want to access. So again, we have a matrix P where we store our results in, and P should have the dimensions. It's a zero matrix that has 4 rows and n columns. So we store it now. Earlier you saw we have stored it in a n by 4 matrix. Now we change it just to do it a little bit different. We store it now in a 4 by n matrix. So our y11, let us define y11 as the excess returns. Y1, there we have the excess returns already stored, and we want to have the rows from 1 until T1, which are the first 250 observations. So observations 1 until 250, and we want to have all columns. So we want to have all stocks. So y11 gives us now a new matrix, where we have all columns. So we have all stocks from the y1 matrix, but only the first 1 until 250 rows. So only the first 250 observations. Then we create a new regressor matrix. Let's call it x11, and x11. Let's create a matrix. So we have already discussed this. If we have these parentheses, it gives you a new matrix. So whatever you write here in creates a new matrix. So what we want to have first, we have a vector of ones, that has the dimension 250 by 1. And second, we want to have our factor matrix here. And again, we want to have the observations 1 until capital T1, and we want to have all columns. So we want to have all risk factors. So what we have done here now, we have created a matrix x11, which is in essence the same matrix as we have constructed here, but now basically we have only the first 250 observations. So what we have here is obviously a 250 by 4 matrix. 3 risk factors and an intercept term. So next, for J is running from 1 until n. So we do something again for in the dimension of stocks. We run our, again, we make use of our OLS formula here. We run our well-known formula here. Beta is equal with x11 prime times x11 inverted power of -1. So times x11 transposed times y11 column j in all rows. So the whole column vector j. Then we store it now in our P matrix, in column j in all rows. And now we don't have to transpose B, obviously, because now B is a 4 by 1 vector, and we store something in the first 4 rows of our P matrix. We end it, and now let's just copy this in MATLAB that we know what we do here, paste it in. So and now what we have, if we now double click on P, it should give us the corresponding result matrix. Yeah, so what we have here in the first row, we have now the corresponding alpha across our stocks. Second row gives us the corresponding exposure against the market factor across all our 184 stocks. Yeah, and now remember that we have now the same dimension. Yeah, so our Y1 or Y11 matrix has a column rank of 184. In each of the columns is the corresponding stock. Now we store the corresponding exposures in a matrix that has basically the same dimension, because we have in the columns the corresponding exposure of the same stock, that is in the Y1 matrix or Y11 matrix, which makes things pretty simple in what follows. So again, in P, we have now the exposures or the factor loadings conditional on the first subsample. What we do now is, okay, we are interested in the size exposure. And we find the size exposure in the third column. So what we have to do is, let's construct a vector and denote it as sort E, the third row, all entries. So now we take the third row, because we know in our P matrix here, which is here we have the exposure against the size factor, right? So, and our command here, A1 sorts basically the whole row, the third row, in P in an increasing order. Yeah. So let's check that. Copy that into MATLAB, and now plot A1. Then we can see how the vector looks like, and this is exactly what it does. Okay, so we see that the lowest exposure against the size factor is something like, let's take the data cruiser. It's obviously minus 0.74, yeah, and the highest exposure is something like 1.92. Yeah. Now, what we want to do is, okay, we want to take the 20% that have the highest exposure, so these stocks here, yeah, we want to buy them and keep them constant for the second subsample, yeah, and we short these stocks, the 20% of stocks that have this lowest exposure against the size factor, yeah. This is what we want to do, or what this exercise aims at. So now, first of all, we have to determine what's the lower bound. What's the lower bound of our in our vector? So in this alpha, in this A1 vector, yeah, and the lower bound is obviously we have capital N observations and times 0.2, 20%. So roughly, we want to have 37 stocks in the portfolio that we short sell, and we want to have 37 stocks in the portfolio that we buy. Yeah, so 37 stocks should be in the sample. So in the sorted vector, it's the observation number 37, yeah, that we're interested in. So this is now basically, this gives us in the vector R1, yeah, because R1 is the sorted vector of exposures against the size factor. So all stocks that have a lower exposure against the size factor than this value here, and let's check what it is. Copy it here in the command window, then we see, so okay, it's minus 0.31. So we want to have we want to know now where are the stocks that have a lower exposure against the size factor of minus 0.31. And these are the stocks that we short sell, yeah, because these are the big stocks and we want to short sell big stocks. So now we also want to determine the upper bound. The upper bound is the observation 184 minus 37. Or we can also write capital N, because we have determined N already here earlier as 184. This is still in the workspace. That doesn't matter. You can whatever you write here. So what's that value here? Let's copy this into MATLAB just to check what's the value here. So obviously we want to buy all stocks that had in the first subsample an exposure against the size factor that is larger than 0.5143. Okay, so the lower bound is this value here, and the upper bound is this value. So we buy all stocks that had a higher beta against the size factor in the first subsample of this value, and we short sell stocks that had a exposure against the size factor that is lower than this in the first subsample. And we want to have a look what is the performance of these stocks in the second subsample. So now what we do now is, so we know now the corresponding upper and lower bound. Now we determine a dummy variable vector. We denote it as LD underscore low. This is a vector of zeros, has the dimension n by 1. It has the same dimension as the vector of this is the same dimension of stocks that we have in our sample. So we have now, we construct a for loop for j is 1 until capital N. So if in the second row of P, where we find the corresponding exposures against the size factor of the stocks in the first subsample, yeah. So if P in the second row, J, yeah, for stock J, is lower or equal than the lower bound, which was minus, you remember it's minus 0.31. Then our D underscore low, J, for stock J, should have a value of 1. Otherwise, it should have a value, D underscore low, J, should have a value of 0. We have to end the if loop, the if command, and we have to end the for loop. So we constructed now a dummy variable vector, yeah, that gives us for each position in the Y1 matrix, it gives us a 1 whenever this stock fulfills this condition here, whenever it has sensitivity against the size factor that is lower than minus 0.31, and otherwise it has a 0 entry. So now we have constructed, now we can, this basically is an indicating vector. It gives us the indication, it gives us the location of the corresponding stocks, where to find the corresponding stocks that fulfill this condition in the Y1 matrix, where we have the excess returns of our survivor stocks. Now we have to do the same for the stocks that have the highest exposure against the size factor. So let's construct again a vector, a binary vector. Let's call it D underscore up is equal with zeros, n by 1, for j is running from 1 until n. Do what? So if in the second row of P corresponding j is lower or equal than our upper bound, So now we have to write higher, right? It should be higher or equal than our upper bound. Then p underscore up, our dummy variable vector, should be 0, else p underscore up j should be, it should have a 0 otherwise. And the if loop and the for loop. So now we created a dummy variable vector, yeah, that gives us a 1, yeah, if a stock j has a sensitivity against the size factor that exceeds the upper bound, which is 0.50 something, yeah, then it gets a 1. Otherwise, this vector has a 0 entry. Now let's have a look. Let's copy this to the vectors. Let's copy everything here. MATLAB. And the sum should be now in, if you take the sum, you know this is a binary vector, obviously. Yeah, if you now click here on upper bound, no, sorry, if you click on d underscore low, it's a vector of zeros and ones. And you see here, it's a vector of zeros and ones. Every now and there should be a 1. And the up. Something has gone wrong here. Let me just check one more time. D low underscore 1. So whenever P3, right? Exactly, P3, because we are interested in the, not in this, in the market factor sensitivity, but in the third row of P, we find the sensitivities against the size factor, right? So this should be 3 and not 2, because in the second row we have the sensitivities against the market factor. So okay, let's copy this one more time. So let's check what is our D low. Yeah, you see now it's correct. It should have, consists of zeros and ones. So here, obviously, the first stock is in the group of stocks that we short sell. Yeah, it has a low exposure against the size factor. So it's a big stock. This and the 6 stock as well, 8 stock as well, and so on and so forth. Let's see the other vector, d underscore up. So obviously the second stock is in the group that we buy because it is a small stock. Yeah, the sensitivity exceeds the threshold, and the same is for stock number 24 in our sample, and so on and so forth. So the sum of our vector should be close to 37. Yeah, and you see it's 38 for d underscore up and 37 for d underscore low. So since this is a portfolio analysis, yeah, it doesn't really matter if this is one stock more or one stock less in this group. Yeah, if it's, because it's rounded anyways 20%. Okay, so that doesn't really matter. So now we have defined this. The next thing is we want to have the excess returns for the group of stocks that we buy. That's denoted as long group. It's zeros. It's a vector. We have to store the corresponding excess returns in a vector, in a zero vector that has the dimension t minus t1, because we lose the first t1 observations, yeah, for our estimation, in-sample estimation, and it is a vector, it's a t minus t1 by 1 vector. Yeah. The same is for the short group, so that's the stocks that we are shorting. Zeros, it has the same dimension. Capital T minus T1 by 1. Next, we have to determine the out of sample matrix, the excess return matrix out of sample, that's denoted as y22 equal with y1. And now we take the observations starting at T1, which is 250, until capital T. So now the last observations of our sample. We remember it's 400, we have 497 observations, and 250 we use for the in-sample observation or estimation, and we have 247 stocks then left. Yeah. So if we take the sample T1 to T, this is then 247. And we want to have all stocks, of course. So then we operate with a for loop again. For j is running from 1 until t minus t1, because we have now so many observations in our matrix, obviously, the out of sample observations. So the long group j should be d up transposed times y22 a, and we want to have all rows, yeah, all columns transposed. And now, because we want this is a return, this obviously defines, it multiplies a vector that consists of zeros and ones with the corresponding excess return at time t, given time t. Yeah, this is now here the time dimension. It runs from over the time dimension, and it gives us for each point in time. Yeah, it multiplies for each point in time the whole return vector of, it's now a cross-sectional vector, yeah, because it gives us the returns of our 184 stocks at time j, and multiplies it with a binary vector consisting of zeros and ones. So if you want to have the average return, because this would gives us basically the sum, if we have only this product here, it gives us the sum of the excess returns that have a that are in the group of of size exposures that are above our threshold up. Okay, so now we have to divide it by the sum of d up. So this is basically, in essence, the number of stocks that we have in our group, which is 37 or 38. So, and obviously y22, and if we have this for j is 1, this is obviously a 1 by n. This is 1 by n. So we have to transpose it to make it n by 1, because what we want to have here is a scalar. It should be a return. Yeah. So, and a return is 1 by 1. So this guy here is 1 by n, because if j is 1 and all columns, we know we have 184 columns. So this is 1 by 184. So we have to transpose it. If we transpose it, it's 184 by 1. So we have to now to multiply it with something that is 1 by 184, because 1 times 184 times 184 by 1 is 1 by 1. So since our vector d up is a n by 1 vector, it's 184 by 1, we have to transpose it so that it becomes a 100, so that it becomes a 1 by 184 vector, a row vector. So now that the dimensions are correctly, and obviously if we would define our upper vector here, if we would define it as a 1 by n vector instead, yeah, we can take away this sign, right? Because now the dimension is correct. Yeah. So the same is now for the short group. We want to have now the average returns of our of the corresponding stocks that we want to sell in the second subsample. So it's d underscore low times this guy here, right? And again, we have to divide it by the sum of d low now, okay? And again, so here now we have to redefine it as a row vector, okay? We have to run it one more time now in MATLAB so that it gets the correct dimension. Yeah, now it's, you see, now these are row vectors, obviously. Yeah, you see. So now go back to the code. So now we have defined for each point in time, we estimate now the corresponding for each point in time in the out of sample. We estimate now the return of the group of stocks that we buy, those that have a high exposure against the size factor, and the corresponding short leg, so the group of stocks that we short sell. So we can now end our for loop. So let's do that. Copy this into MATLAB. Voila, it worked out very well. Let's see, long group. Here now we can plot it as well. Plot the returns of the long group over time. So you see we have obviously here returns that are sometimes, it's very volatile here, obviously, and this is maybe the most likely the financial crisis period, what we see here. Yeah, so we have returns from above 20 and below 20, so it's a very volatile period. And we have the same probably for the short group. The out of sample, yeah. And obviously, because these are big stocks here in the short group, yeah, a little bit less volatile. Yeah, we have here values until 15 and minus 15. For the smaller stocks, we had minus 20 and 20. So obviously, we can also plot them together. What we have to do then is plot, yeah, these parentheses. Then we have these brackets here. Then we have long group, leave a space here, then short underscore group. Then we have to close this parenthesis and then the other parenthesis, and now we get a plot from both and return evolutions in the out of sample in the same plot, which we see here, right? So now we remember the green line obviously is less volatile, so this is the big stocks portfolio, and the blue evolution here, the blue line, is the corresponding time series evolution of our portfolio of small stocks. This is the portfolio that we would keep, or that we would buy and keep in the out of sample period, right? So, but now we also would like to know, okay, what's then the zero cost strategy? So the zero cost portfolio is defined as long group minus short group, right? And moreover, we want to have the mean. What's the mean of the zero cost portfolio? What's the mean of zero cost portfolio? And what's the t statistic? So the t statistic is defined. T stat, what is it? Well, it's the mean of our portfolio divided by the square root of what? take the variance of the zero cost portfolio and divide it by the number of observations, and the number of observations is t minus t1. Close the parentheses, close this one as well. So let's copy this into MATLAB in the command window, and what we see is then the corresponding point estimates. So what we see is, okay, obviously those stocks that had a high exposure against the size factor in the first subsample, if we keep them in the second subsample, they have on average 0.31. If you round it, it's 0.31% per month higher returns than those stocks that had in the first subsample the lowest exposure against the size factor. Yeah, so that's the size spread of the survivor stocks in the second subsample out of sample. So the t statistic is 1.08. Yeah, 1.08, which indicates that this spread is statistically not different from 0, right? Since it's within the critical values of minus 1.96 and 1.96. So obviously, it would not have been beneficial to invest in small stocks, or it would not have been beneficial to invest in stocks that have been small in the first subsample. Yeah, this is what we can see. So our final exercise now, time varying betas. So use the first stocks in the excess return matrix and estimate the loading against the excess market factor, size factor, and value factor across time. Use iteratively a rolling time window of 60 months. Store the time varying estimates for the exposures in a matrix and plot each of them across time. So now we are in the fourth exercise. Time varying exposures, okay? So let's define T. Oh, we have actually already done it. T is the length of F. We can also use RF or Y. We know that already. So we use 60 months as a rolling time window. Again, we store our results in the matrix P. And now again, we overwrite, obviously, our previous result matrix P. So we have T minus H time series observations. So we have T minus H rows and 4 columns, right? Because we have 4 in our model. Here we have 4 parameters to estimate. So then we operate with the for loop. Yeah. So obviously we lose capital H to 60 observations because we use it as a rolling time window to estimate our exposures against the market factor. So again, we have to we want to retrieve the first stock. So our small y is then from our capital Y matrix, yeah, the first column. Yeah, this is the first stock that we have in our sample. So then we have a for loop. For I is 1 until capital T minus H. Yeah, we do something now until T minus H because we need the last. We lose 60 observations. Yeah. Then what we do is we say y1. We define a vector that has from our y vector the observations I until I plus H minus 1. So if I is 1 in the first iteration, it takes the observations 1 until 1 plus 60, because H is 60 minus 1. So 1 plus 60 is 61, minus 1 is 60. So it takes the observations 1 until 60 in the first iteration. In the second iteration, when I is 2, it would basically take the observations 2 until 61. Yeah, and so on and so forth. We define our X1 matrix as matrix of ones. Vector of ones is in the first column of dimension h by 1, and we take the factor matrix. Yeah, we take the row I until I plus h minus 1. Yeah, the same dimension as we have here. Yeah. So in the first iteration, we take the observations 1 until 60. In the second iteration, our regressor matrix grabs the observations 2 until 61, and so on and so forth. Very simple. And we take, of course, want to have all risk factors. Yeah, all of the risk factors of our factor matrix in the X matrix as well. So that's our conditional X matrix, our conditional regressor matrix. That's our conditional vector of excess returns. Now our B is obviously, in this case, X1 prime times X1. And this guy is taken to the power of minus 1 because it's inverted, times X1 times Y1. Yeah, and obviously in each loop, this is on iteration in this for loop here, this is always overwritten. Yeah, it's estimated always new, so we get always a new beta in each iteration. Now we store these corresponding betas in our P matrix, and that is in Pi in all columns of our row number I. Yeah. And we have to transpose this guy. We have to transpose our beta estimate because obviously we have 4 columns in the first row. Yeah. And B is a 4 by 1 vector, so we have to transpose it so that the dimension that it fits here in, right? So we have to transpose it. So B transpose is 1 by 4, and this here is also 1 by 4. So now we can store it. Now we can end our for loop, and let's see what comes out. Let's copy this into our command window. So now it says that the matrix dimensions must agree. So now we have to check where's the error. So let's see what's wrong here. Let's copy it again now. Once again, our P matrix is zeros. This is correct. And Y1 is defined here, right? Y is defined here, so we don't, that's also correct. Does it recognize X1? X1 has the correct dimension as well. Y1 is the correct dimension as well. Our P, let's check our P. What's the dimension of our P? So P obviously has the wrong dimension, right? No, it's not. It's not wrong. So it's this guy here. So we have to transpose, it's x transposed x inverted x transposed y1, right? So we have it here. This guy needs to be transposed, this x. So okay, now it should be correct. Let's again copy this into MATLAB, corrected code, and paste it. And now it should be all right. Yes. So let's now plot the evolution of our beta. So if we now plot, if we take P and we want to plot the first row, the first column vector in P1, which is the alpha of the first stock across time, we see that the alpha obviously decreases. Yeah? So the intercept decreases across time linearly. So the abnormal return was high in the beginning of the sample, and then it's basically 0. Second is the exposure against the market factor. Yeah, so this stock obviously was co-moving with the market factor almost with the exposure of 1, and then it becomes it has less exposure against the market factor in the later subsample. Then we have in the second column the exposure against the size, in the third column the exposure against the size factor across time. So we see it was a big stock in the beginning of the sample, and actually it remained a big stock, but obviously there's some time variation. Yeah, so it obviously changed in size or in its sensitivity against the size factor. Yeah, so we see it became sort of bigger towards the end of the sample. Yeah, because the exposure is highly negative towards the end of the sample, and it was slightly negative in the beginning of the sample. Then if you check the exposure, the time variation against the value factor, yeah, which is obviously given by the fourth column in our P matrix, we plot it again across time. What we see is, okay, obviously this stock was in the beginning of the sample. It was a growth stock, because the beta against the value factor was negative. So it was co-moving with the short leg of the value factor, which are growth stocks. And then towards the end of the sample, this growth stock became a value stock. Yeah, because the exposure against the value factor became positive. So it was co-moving with the long leg of the value factor. Yeah. So what we see is obviously that the betas, the exposures against risk factors, have time variation. Yeah? So that's an indication for time variation of the betas of the stocks.